Why did I choose investing as my 20% time project? Well, for most, it seems complicated, scary, maybe even risky, and that's how I felt before this project. But I wanted to fully understand the different type, not just the different types of investments, but how they work and what actually builds wealth. Over the last few months, I've researched different types of investments and even invested in some personally myself. I really wanted to understand what works long term and builds wealth, and what realistically works for somebody who's starting out at a young age, like 18. Before ranking investments, it was important to me to define what wealth actually meant. And that's where this book, Rich Dad Poor Dad, came in for me. It teaches you about how wealth isn't just about having money, but having assets that give you freedom, security, and flexibility. There's a difference between income and wealth, as income is something that you've earned, and wealth is something that you keep and continue to grow over time. One person can have large income, making a lot of money, but still be struggling financially because they spend all of it on things that don't build any wealth. On the other hand, one can make less money, but invest consistently in assets, letting time do the work for them, and end up wealthier than the other. And that idea is influenced from this book, telling you that wealth is what puts money in your pocket and liabilities takes money out of your pocket. And it taught me to invest logically instead of emotionally. To rank each investment fairly, I use the same criteria for all of them. First, long-term growth. Does this investment grow over decades, or is it more of a short period of time? Second, risk and volatility. How much does this value go up and down, and how is it predictable? Third, accessibility. Can a normal person start investing, or does it require a lot of money up front? And finally, inflation protection. If an investment doesn't beat inflation, it's not really growing in real terms. Using these criteria, it helped me compare investments logically instead of just following the hypes and trends. Let's start with the most basic place people put money, in their cash and savings accounts. Now, a long time ago, saving money in a bank was actually a very smart financial move. Decades ago, interest rates on savings accounts were much higher, sometimes 5% or more. Inflation was lower, so simply saving money could slowly increase its value. At the time, saving was a legitimate way to grow wealth safely. But today, the situation is very different. Most savings accounts now pay very low interest, while inflation continues to raise the cost of living, food, housing, gas, and everything gets more expensive over time. So even if your savings account balance goes up slightly, your money usually buys less than it did before. In Rich Dad Poor Dad, there's a strong emphasis on how saving cash just isn't enough anymore, as inflation keeps eating away at it. That idea helped me understand why cash feels safe, but does not actually build wealth over a long term. Next are bonds and treasuries. When you buy a bond, you're essentially lending money to a government or company, and then they pay you interest in return. Bonds are generally more stable than stocks, which makes them appealing to people who want predictability and lower risk. But the downside is the growth. Over long periods of time, the bonds actually grow much slower than stocks. They help protect money, but they don't build wealth aggressively. Because of this, bonds are better used for stability and balance rather than a main wealth building investment, especially for younger investors. Stock represents ownership in a company. When you buy a stock, you're buying a small piece of that business. As companies grow, innovate, and become more profitable, their stock value can increase over a long period of time. That growth can be compound. Stocks can be volatile in the short term. Prices go up and down, sometimes sharply, but historically, data shows the stock market has trended upwards. Another part of stock investing is dividend investing. By reinvesting the dividends you get from those stocks, you buy more shares, which produce more dividends in the future. and creates an additional compounding effect over that long period of time. Another idea from Rich Dad Poor Dad is the importance of ownership, and that you're not just saving money, but you're owning parts of a real business that is growing over a long period of time. That ownership is a big reason why stocks play a big role in wealth. Index funds take stock investing and make it more consistent and accessible. Instead of betting on one company, index funds spread your money across hundreds of companies at once. The diversification lowers risk and smooths out all the returns. Index funds are also very little effort, so you don't really need to pick individual stocks or consistently trade. Real estate is one of the biggest assets in the entire world, and it's a major way that people build wealth. Property can generate income through rent and may increase the value over time. However, real estate usually requires a large upfront investment and ongoing management and repairs. Because of that, it's not always accessible for beginners, but with real estate investment trusts, they can make real estate investing more accessible, and they allow people to invest in real estate through the stock market without owning the property directly. In Rich Dad Poor Dad, real estate is often mentioned because of the large income and increasing value of the property. That helps explain why real estate ranks high on investing, even though it requires more work. Cryptocurrency is one of the newer assets and has become extremely popular over the recent years. Crypto has shown massive upside potential, but it also comes with extreme volatility, and prices can rise and crash just as fast. Another challenge is that crypto doesn't have the same long-term history as stocks or real estate, which makes it harder to rely for consistent wealth building. Because of this, crypto is better viewed as a speculative asset and something people choose to include, but not something to depend on as a foundation. After researching, comparing, and testing these different investments, a clear ranking has appeared for me. At the very bottom is definitely cash and traditional savings. It's safe, but it's slowly losing value due to inflation. Above that are bonds. They're stable, but they have very slow growth. Higher up are dividend investments and real estate investment trusts. It's a solid long-term strategy. At the top, for a young investor and a normal person, I decided to choose index funds because they are diversified, accessible, and overall historically reliable. But overall, real estate has to be the top tier investment. But that's mainly for people who have money and time to manage it. The biggest thing I learned from this project is that wealth isn't just about finding that perfect investment or chasing those trends. It's about consistency, patience, and just time. Now, the main idea from this book is that wealth is consistently acquiring assets over time. And that idea lines up with everything I've researched and tested myself. Now, my final point is that the best investments are ones that consistently grow over decades and not days. That is true wealth.